GameStop was a little-known video game retailer just a couple of months ago. Its shares were worth only a few dollars, but by late January, shares soared over 1,000%, surging to more than $480. The sudden rise in value was driven by small investors on the social media platform Reddit, betting against short-selling professionals.
Stock starts to move up a little bit. It gets a bit of FOMO. Everyone starts buying it. That wave of capital really starts targeting individual stocks. With that short level of interest, the short sellers will close. That again pushes the price up.
Once you get that sort of momentum, what a fund can also do is use the retail traders or the syndicated traders as almost like a front or a cover for them to come in behind and give that additional push. So maybe the money's been made and now people are starting to unwind those positions and look for the next opportunity. I think that's the risk as well.
The meteoric rise of GameStop shares, fueled by the social media-driven buying frenzy, seems to be fizzling out. Shares more than halved in value earlier this week, narrowing losses for short sellers.
It's somewhat concerning if the party can continue. Because I mean, the nature in which these stocks are being identified or these short squeezes are being identified is concerning because of the internet and the access to information that these retail or syndicated traders have now. It's very difficult to regulate. So it could go one of two ways. It might be a short-lived, I guess, experiment for some of these syndicated traders, but I mean, because of the large returns, you would think that maybe they'll be looking for their next GameStop opportunity.
Shorting shares of GameStop cost hedge funds over $12 billion in January.
So different funds will hopefully have their own risk tolerances. And you go to some of these funds that have lost 50-odd% as a result of what we've seen from GME. And of course, the question that a lot of people are asking is how on earth did they manage to lose such incredible sums of money? These guys are supposed to have some of the most advanced technical tools or technology to limit their losses, against that, volatility spikes and various factors. But these are unprecedented times.
Similar to GameStop, stocks like AMC Entertainment also saw a dramatic short squeeze as share prices soared. Silver, which has also been under the spotlight, has been more immune to short squeezes, especially as it's much more liquid. That's why market watchers say executing a short squeeze is not so simple.
Three factors have to be in play. So first and foremost, the short interest has to be high. So as you see from GameStop, this stock was a short interest of about 140%. And second, there has to be kind of a positive catalyst that actually would want to convince these retail investors to come in to buy up the stock. And the last point is that for a short squeeze of this magnitude to happen, there has to be a lot of buyers who are trying to buy up this stock. And like we all know, this collective action of buyers buying up this stock was actually triggered by popular social media forums such as Reddit, as well as even Facebook and Twitter.
With its many checks and balances, analysts say the likelihood of such price manipulation taking place in Singapore is unlikely.
I'm not going to rule out the possibility that a situation like this could happen in Singapore, but I think the possibility of this happening is also lower. This is due to the fact that unlike US, Singapore doesn't have commission-free trading. So for instance, Robinhood offers retail investors commission-free trading, making it very accessible for them to go in to buy the stocks or perhaps trade options, which are very risky. And there are more restrictions on short selling in Singapore. So for instance, if I do want to go about short selling directly, so I have to sell the stock, but at the same time buy back the stock on the same day. And also if I'm trying to use like daily leverage certificates, I also have to be qualified to actually kind of use these instruments to actually go about shorting the Singapore SGX listed stocks.
Everything is very well watched over by the MAS and obviously the exchanges here as well. So I don't think the ability for a syndicate like that to come in and squeeze, one of your sort of lower liquidity stocks would really be possible here. I think maybe with the SEC in America, they should have moved a little bit quicker.
The massive losses that hedge funds saw because of the squeeze could usher in a new way of doing business.
In this new model, unless it gets changed by the regulators, then you're putting your hand up and you're saying, I'm involved in this big position that could get squeezed. So I think that model is under pressure. The other side of the thing is the long-short hedge fund model. Because if I'm a long-short hedge fund, I'm looking for relative value in my trade. So I've got a long leg and a short leg. A lot of people have taken their exposure to shorts off the table or reduced them. And as a result, they've had to counterweight that and they've had to reduce their long positions. And if you add those two together, you get the long and the short leg together, and you look at the gross and net exposure through hedge funds. They've been at record levels.
In Singapore, authorities have reminded investors to be careful about financial discussions on social media. In a statement, the Monetary Authority of Singapore and the Singapore Exchange Regulation said there could be possibilities for similar speculative activities on the Singapore stock market. They warned that such activities could amount to market misconduct and that firm action will be taken against violators.